check that the microphone is working. It sounds like it. So good evening. Karen Cockburn, I'm the CFO of Impax Asset Management. Very much a differentiated specialist in investing in the transition to a sustainable economy. I think I did the presentation last year to say, look, it's important that we differentiate what we do from ESG. I'll get into that in a little more detail. I was here last year, and so I think there'll be some very interesting contrasts between the different approaches to fund the three funds really, and that we'll look at today, which compares to last year. I stood here with 2 miners and an oil exploration company. I see if anybody remembers that. And then also last year I was asked quite a number of questions going, okay, so Impax has been, it's 26 years old this year. It's on the AIM, it's been on the AIM for 26 years. And it's actually one of the bigger companies on the AIM, and it was, why are you here, Karen? And the answer to that really is, look, we have some, long-term institutional investment, but we really want to focus on growing and developing our retail base. So what I'd like to do is just take the time to sort of, hopefully, they've given me 30 slides, hopefully we can get through them quite quickly, and just really explaining sort of, what is the opportunity at, Impax in terms of the growth available in this stock, and really just sharing, against a global backdrop where investing in the transition to a sustainable economy is like at a hugely interesting point in time. So moving on, sort of if I can, just for those that are new to Impax, who are we? So we're a 26-year-old asset management business that's 40 billion of assets under management, 95% of those in listed equity. We've got growing and very exciting opportunity into fixed income, and we also have a small private equity business that builds and sells wind farms and solar farms across continental Europe. Very much a specialist asset manager. If you're pitching an asset manager as a proposition today, I think you have to be specialists. The generalists, are under threat from passives, so you really have to have a very clear and specialized bunch of assets that you're going to invest in, and I believe that's what we have. We've over 90 investment managers across the globe, just as you've heard about, in Singapore, how important it is to be local. We've offices, as you see there, in UK, US, Hong Kong, where we have the local speakers, etc., across Asia. Japan is new for us over the course of the last year, and we run our UCITS and distribution for Europe out of an office in Dublin. And you get a sense there that we have in place global distribution, and we seek to we've got some very big partners. So overall to summarise, we're a specialist. We've got about 23 different strategies that you can invest in across 15 to 20 countries roughly where we're operating today, and with a wide, diverse bunch of over 90 clients operating. So it's a mature business, is what I would say, with great opportunity ahead of us. But fundamentally, when I go back to, there's a very, very strong investment philosophy that has not really changed since the first day. It was founded 26 years ago by a chap called Ian Sim, who is still the chief exec. And what it really plays into is sort of the world that we're in today, and have been for the last number of times, early identification. We're living on a planet with finite resources. There's changing regulation. Technology is changing everything around us. And there's these evolving consumer social factors that we just looked at, for example, the emerging middle classes, the emerging demand for healthcare across the globe. And therein, this investment philosophy focuses ruthlessly on, what we see, these sectoral transformations, mini-industrial revolutions in transportation, in water, in energy, in agriculture. So a very targeted approach. And that doesn't make it ESG, because what you've got is, therein what we see is mispricing, the opportunity for alpha. So first and foremost, that is what Impax is focused on a capital return by focusing on this clearly growing inevitable transition that the world is underway. And Impax is now a global leading brand in that space, and authentic. It's the authenticity that stands sort of true. And this is a graph you hear about, it's when you're at management school, you think it doesn't exist. This is the success rate of this business over the last 26 years. So there's two key points really, two things, there's lots on this graph, but key moments, I think, that were very successful for the business. So growing steadily along, 2017, we acquired a business called Impax Asset Management based in New Hampshire in the US, which had started by Pax, meaning peace in the Vietnam War, and that they had just took this differentiated position that evolved into looking at, focusing also on the US. We had them originally as a distribution partner, and that roughly doubled the assets from 4.5 to 7.3. But thereafter, the growth into sustainable economy in the US really took off. And that drove us forward until about 2020. And if you look at that jump in the years of lockdown from 20 into 21, from 20 billion up to 37 billion in assets for a small company there was about 100 people in the business at that stage. And that growth was really, so part of it was, yes, we talk about it's not ESG. However, it's at that focus, but it does attract ethical investment. And that was what we saw that drove a lot of that was during lockdown and this whole push into ESG. But the important thing I would point out is ESG, and you're not allowed to say ESG really, is how we like to approach it in the office. But that's a fashion, a badge that we believe will come and go, and I think that's what we're beginning to see. But the important thing is we're holding on to our assets. We're holding on to our clients. We haven't lost a client through that period. And the last, for anything to do with equities have been out of favour as interest rates have increased over the last 2 to 3 years. A lot of money has left equities and has gone into cash, money market accounts, and into fixed income. And we've been facing into that. But the underlying asset has actually been growing up until a tougher period that we sort of faced this year. And what we're beginning to see is performance is beginning to return for those, our approach is growth at a price, at a reasonable price. And as a result of the rising inflation rates, that the actual companies that we're investing in have fallen out of favour equity-wise. But the underlying factors haven't changed. You can also see then, just keeping an eye on the dividend from, what was that, 7 years ago, 2.9, and last year, tenfold growth in that. But I think that is just a chart that, where will it go from here? I think I'll need more space, hopefully, for the future years if we're here. But hopefully that gives you the sense of just the opportunity. There's no other organisation that's been doing this for 26 years. Where we find ourselves just now, we just had our half-year results last week, and the share price has taken, quite, I think, on the day, up to 15% fall. From, that's a reaction that our brokers are completely surprised by. But, because we talked about the AUM being up at 39.6 billion, which is a turnaround in the investment performance. We have, the clients are sticking with us. That's a key point. We continue to launch new products. We have this huge opportunity in now building out fixed income, and we have acquired a small but very successful business in Denmark from which we're going to seed a global fixed income business. We continue to build that global reach, and we're pretty much there. We've got optionality, and we continue to really build efficiency into the business. And I think maybe, so what it meant was that whilst the asset was growing, the average asset, when you look out over a 12-month period versus a 6-month period, the market's been very volatile. Very simple business model. Your average assets times the margin, and the margin is holding up. And the averages have just been against us. So we reported a revenue reduction. We reported flat costs, which was a very important message to sort of say we've built this business that we wanted to. And equally, we've won several awards there, in particular the King's Award was awarded to about 250 companies in the UK, the only asset manager to have received that. So we continue to sort of drive forward even though we're facing into some headwinds. The headwinds that we're talking about, just the chart, the colours haven't come out as well as it did in the previous presentation. Normally this chart is the other way around, but draw attention to sort of, we talk about net inflow, or net flow position, which for the last 6 months that we just announced, we had a net outflow of 2.7. That was on top of about a 1.2 the year before, or the period before. But you can go back to the periods behind that where it was net in. But what you can also see in that black box is that turnaround in the performance and the rise in the AUM. And that is because the companies in which we are investing are becoming, are returning sort of in the favour, the equity markets are returning. I'll get into that in a little bit more detail. But we find ourselves, huge growth over a period of time, challenging headwinds, macroeconomics with interest rates having moved, but we see that coming, that will change over the course of the next 6 months. The money that left the equity market, maybe not all of it, but a lot of it we expect to return. And we definitely see that sentiment, begin to see those early signs. The point that I've made is that the companies that we're investing in, through this period of equities falling out of favour, the earnings of those companies are growing. So we're able to go out to clients and be able to show them the underlying health of the companies that we're investing in. And this transition, it's like gravity, this transition to, and the anti-ESG movement that you have in the US, the transition to this new economy, it is happening, it is not going away. And we feel Impax is tremendously well placed. A couple of graphs here, sorry, the colour lime green, I must say, doesn't come out terribly well in this projector that we have. But if it was to move on to a couple of slides that sort of, if you look at other asset managers that are listed in the UK, their revenue shortfalls have been double digit. The revenue shortfalls have been double digit. Their share price, they have fallen further. And Impax still retains sort of a premium, even as the price itself has dropped. It still retains a premium and is seen as the quality asset manager to be investing in the AIM. And one of the reasons for that is just the diversification that has been built into the business. So just a couple of slides, they're awfully hard to see, I apologise for that. We talk about our product, our listed equity funds in two main lenses. There's environmental markets, which were the ones that we started from the beginning, that it was purely water or purely food, these very, very specialised funds. But then in about 2015, we sort of launched a more broad-based, the next phase of growth, our global opportunities, which are still very focused, they have to be focused on this transition to the sustainable economy, but just gives us a broader universe in which we can look for the companies where we see the alpha. And you can see that sustainability lens is now 36% of the overall assets. So we still have this very strong environmental market piece, but we expect over time to see that diversification increase. And then I said we've got about 20 different strategies, 22 different strategies, and that really is just sort of a broad. The Asian environmental, it was interesting when we were talking about when you were building an income fund in Asia versus, I don't have all the detail, but if I lifted the lid on our Asian environmental fund, we'll be in all the startups and the smaller companies that are pre-dividend, but just shows you sort of the different positions that you can take across that. And continued diversification through when you stand back, where are our assets based? And you can see, you can't see, you can only see the dark lines as they're getting a bit lighter here for me as well. But look, 50%, so 46% of the business is coming from Europe, where we've got very strong Scandinavian, French, German, and not so much German, sorry, that's a new country that we want to get into. But the story of the transition to a sustainable economy hasn't changed in Europe over the last, in fact, it's probably multiplied over the last number of years. The US is making up for our assets about 27% just now. So well diversified and great opportunity for growth we see in the US. Importantly, only 22% of our income's coming from the UK. So, as we're seeing how sort of, the challenges that the UK FTSE itself and UK asset managers are facing, that the impact on Impax is much diluted because of this diversification that we have. And yes, growing in Asia as well, particularly Japan. Not so much China, Japan and Australia are sort of where we're very focused on there. And BNP, you can't, when you look at the success in that growth curve I showed you, is that a lot of that came from BNP. They've been a distribution partner for us across Europe. 3 years ago, that was over 35% that they contributed. So we had an active strategy of building our own distribution to dilute that impact. And that's now coming through, that's heading towards less than a quarter. BNP also own 14% of the company. That's a very solid relationship that we have, and we see that distribution arrangement continuing into the future. But the differentiation of it's really important as well. I'm just in the interest of time, now there's a nice picture, but actually I think I've pretty much covered everything on that in terms of where we are. With the last point that, in the US, in Europe, our pipelines are very, very healthy. Asset allocators have just been, they're sort of paused in this move, and it's a bit of a watch and see before, a move back into equity. But here, just moving on, as a picture, it's really important just to show the flows, and if it's to the, as you're looking at it, if it's to the right-hand side, it's positive. If it's to the left, in the prior period, if it's to the left-hand side, it's negative. And basically, over the course of the years, this asset allocation conundrum out of equity has played through, that we have this is the net flow. Pretty much every territory has been in net outflow. Not a huge amount, but it has been. We have a relationship with St James's Place. Now you can see we've all heard about the issues that they have placed. What I can say is that the Impax fund that we have with them, the Impax strategy, is at the top of their consumer duty value for money. So that's a very good position. It's the best position we could be in, but we work with them through sort of the issues that they have. Our biggest supplier, BNP, they were asset allocating. This is 3 or 4 people that sit in a room in Brussels who decide where the money goes. We've seen a turnaround in that in the recent weeks and months, I'm pleased to say. And then I think as you look at, Asia Pacific was marginal, but it was like the whole world is just waiting for something to happen. But we believe we're very well placed when these decisions turn in our favour. This gives you just a picture of the distribution that is in place, well targeted. And this year, actually, we started our first distribution arrangement in South America. So we really, really are global, so it's a small company with a big global footprint. And then just was going to sort of real growth opportunity we see in fixed income. We bought this small business, very successful business in Denmark, and we'll just sort of say, as a CFO, I inherited after that period of great growth, where we'd all that revenue coming in. It took a few years for the costs to catch up, which they now have. Very strong balance sheet, a lot of cash. So we've sort of said that we do want to make some, not large, but some very strategic, careful investments, and we'll do that in the fixed income space. We did talk about listed equities, this global social leader. So we'll launch these 3 funds, and we think we're done. And we have built ourselves a listed equity business. Okay, today it's about 36 billion of our asset. We believe we can get our overall asset up to about 80 billion without investing much further into that listed equity business. We've built the distribution, we've built the strategies, and where we will be investing is fixed income, where I've spoken about, and then private markets, where it's onshore wind and solar across Europe, and we're looking at the US to see where the opportunities will arrive there, pre or post a Trump. Whatever's going to happen in the US, we feel we're well placed. We do focus on, we've got 18 people dedicated. This is how we really differentiate ourselves to our clients and therefore become very sticky, is through the Sustainability Centre. The amount of reporting that has to be done wherever you are in the world about the sustainability credentials. And what we've done is pull together all the people in our business who were looking at this. Clients love this. It's a great differentiator for us. I'm going to skip over just to finish in my last minute on just the financial highlights, which hopefully you can see the blue lines. So we just reported our results. So look at the profit. So the revenue of 86 million, that's the shape and size of who we are, is revenue of 86 million. Our assets under and growing assets under management that we've talked about. Our profits got pegged back a bit this month because of this the averaging. We're on the right side. We're on the up on this average calculation. But the market, I think what happened here was the market we announced a very strong AUM in March. There was some maybe lazy analysis done to say then some profit growth will follow. But the profit growth, because of the averaging AUM just over the 6 months, pegged that back. But the underlying fundamentals of the business don't change. You can see that, it's not on the chart, but you can do the maths. The cost stayed flat, which is the proof point that we believe we've built a business that will just scale and scale quickly from here. We have our operating margins that we maintain, and we think, we belong somewhere in the mid-30s is what we aim for. And we did change our dividend policy slightly this year, which previously just announced that previously was we paid between 55% and 80% of adjusted profit after tax. What we've done is we've removed that cap. We've set that to the side, such that the policy is now that we will pay 55%, at least 55%. And the reason that we've done that in just this sort of timing period that we're in, we remain, the conviction that we have in the growth opportunity for the business, alongside the cash and rich and healthy balance sheet that we have, that cap really was serving no purpose for us or for potential investors. So for that reason, that we've changed the policy, we've held it flat where we are, but our long-term view is that is something that we seek to grow and grow. You saw the growth that we've had since 2017. And that was really where I was just going to finish, other than, look, what fundamentally is this business? It's differentiated. And I would say really, if operating in a compelling market in this transition to a sustainable economy, and just sort of saying is, look, for any investor who's looking for exposure to a specialist fund manager that is seeking to drive sort of upside returns, really diversified in its global reach, its global brand, and extremely well placed in its ability to grow when the sentiment returns, and we're seeing early signs of that returning into our listed equity with great opportunity to grow on that fixed income side of things. So anybody who's looking for exposure to that, I would just encourage you to look closely at this organisation. And with that, very happy to, I'm 1 minute over, but very happy to take some time to answer some questions. Thank you.
Thank you, Karen. Any questions? Open things up. Got a question, just gentleman over here.
I'm not sure about the gentleman, but thank you anyway. As a shareholder, I always have a wee look at the share price graph. If I've got the right share price graph for you, in 2021, you were £14 a share, and now you're £4.
Yeah.
You're down 70%.
Yeah. So, explain, okay? Well, first of all, do I see the value in where the share price is today? Even though at £4, we're still trading at a premium to the sector for asset managers in the UK. So one, there is an element where the share price has been pegged back because of the whole sectoral view, and it still remains above. So, as I said, that we're still viewed by institutions as a quality asset manager. So there's the whole sectoral piece. I had many investments myself in 2021, focused into these growth areas, not part of Impax. It was before I even knew about Impax. And what I'm seeing in Impax, and that pullback from that share price is a function of principally inflation, as these are growth stocks, and Impax is viewed and was by the wider investment community as a growth stock itself. And with inflation rising, every growth stock that there is out there suffered significant pegging back by the simple modelling of the higher inflation, higher discount rate, lower valuation. So I think, and it was, the third point I would say is that Impax itself was that was a price, if you go back to that graph, you could sort of say it was justified, seeing that growth had happened, doubling nearly in the AUM, and the expectation that that continued. And then we hit the world of inflation and interest rates and equity falling out of value. So I guess the question, will we get back to that share price? Look, if I put a graph up that shows that curve continuing, there's no reason why not to. But what are we focused on just now is getting the asset, are we invested in the right companies for our clients? Yes, we need to see performance turn around. So the other way, so do I see the share price improving from where it is? Absolutely. When the market sentiment and the macro factors settle down, as the slide says. Do I expect it to get back to that level? That's a very difficult question to ask. That's so many. But is there anything specific? The real thing for me, is there anything specific to the Impax story that will hold it back? And some other sectoral factors. It appears it's all part of broader sectoral and macroeconomic factors. And once they settle, and what we can do is we're growing this company. We've built something that can be scaled. And in many ways, look, I can't understand the share price today, is the other thing. I think also we maybe reflect and say we maybe didn't really understand it when it was at £14. But all I can, sort of share is sort of that conviction that the organisation has that this is still a growth engine. And, are we at a turning point when we see sort of equities, inflation, all these macro factors turn around? So,
great, thank you.
Yeah.
Got another question just here.
Hi.
And then.
It's great to see a business with cash on the balance sheet.
Yes, thank you.
You don't do a buyback, though.
No, and that's because, so we don't, because we believe we've still got a lot of growth opportunity, and we're still very much in that startup phase. So that's exactly what we're planning to do. We do buy some shares, look to avoid dilution into the EBT, but no, for that reason that we still very much believe we're growth, that's off the table.
So we've got a question here, and then I think the gentleman over there. So if you go first.
So should we not have the dividend yield in your top screen there? It's about 6%.
Yes, just now it is. Yes. So do you know, if you looked at my page that I said how these charts need to change?
Oh, okay.
So yes, it is about 6. Yeah.
And you said you're going to have new products. So what is that going forward, and what do they involve? And is there any areas of new investments that you haven't tackled before? Because some of the investment, like wind farms and all, they're maybe not as lucrative as they have been.
Yeah. So if I look at this business now, we said it's three listed equity, so we're done. We launched 3 new strategies. We say we're done. There'll be no more new investment in that. Then I talk about fixed income, where we do see that this opportunity of taking this transition to the sustainable economy. We've done it in listed equity, now into fixed income is a huge opportunity. And this bunch of small business we've bought in Denmark has proved that can work. So we're going to invest in that, and that's what we'll spend some of the cash on, right? We're clear on that. Then when we talk about the wind farms, so this is our private equity business that we do fund by fund. So we have just finished and closed a record level, our Fund 4, which was 460 million euro. Okay, so we'll spend the next 4 years finding wind farms, building. We buy the fields in these funds and put up the wind farms and sell them immediately. So it's a quick turn, closed-end funds over 10 years. So it's really interesting in that, on one hand, that you see the costs of building and building these wind farms, of all of these. But the counter and to why we continue to sell them at very, very high profits is the demand across Europe is huge for this infrastructure. So we're not, so it's that sort of the increasing cost, but this demand seems to be insatiable for us in terms of being able to sell. So we're very focused on the markets that we operate in. We've got a team who've been doing it for 20 years. So I think that's, and that's, we're investing client money rather than the corporate money into those.
And the last part, do you have any direct investments? Do you actually hold any companies with, owned directly by you, or is it always just managed funds that you have?
So there's, in terms of in that private equity business, then, we own 1% of every fund. So there's a requirement that will match 1%. And then, of course, you've got carry, if you understand the world of private equity, that, the individuals and managers involved have heavy interests, aligned interests. But, yeah,
excellent. And then just time for this question over here. Yeah, go for it.
I just want to understand your investing philosophy. So you're saying that you invest for a capital ton on wind farms. You buy the site, develop it, and sell it on.
Yes.
All right. So you don't depend upon subsidised income then.
No. This is just this private equity. It's a small, very lucrative part of the business that you get it to a point. So we'll have all, we gather the fund, we identify the asset, we build, but then the minute you secure the permits, that's when investors can start nearly the sales process.
Okay. And you do similar things for solar farms?
Solar farms, yes, but all mainland Europe. We've just actually, in that last fund, the Wealth Fund of Ireland now, they're very heavy investors. And there's a lot of solar farms. Where we see the opportunity for this is in the US.
US?
Yeah.
Excellent.
My other question really is, how many of your companies are actually operating profitably with a profit?
And now, are you talking in the listed equity business?
Yes.
I would say all of them. In terms of, so we don't invest, so for example, hydrogen, that they don't invest in that because they just don't see too many nascent companies. Right. So, we have got a small cap fund and a large cap fund, and even in our small cap, because it's US based, it's still quite large. So no, these aren't startup bets. Right. These are well placed, meet quite strict criteria. And then why sort of the whole valuations and that whole market's fallen out of favour a wee bit is like they've just been, taken back and because, they were growth stocks. But the earnings have just continued to tick along, and that's what gives me the reassurance.
All right, just to circle back. When you make a capital turn on an asset...
Back into the private equity business?
That goes back into the private equity business? Or do you sometimes make special dividends? No.
So we will, so at the end, when a fund that we just closed, right, that will run for 10 years, 5 years that we're doing closed fund, we invest and do the assets, build for 5 years and then sell for 5 years. So our NEF3 fund, which was the prior, it's now 7 or 8 years old. So it will come to a close at some time in the next 18 to 24 months. And yes, I think if you look back at that dividend picture, there was a special dividend when the prior fund, NEF2, New Energy Finance 2 fund closed. There was a special dividend at that point.
So just to understand this as a shareholder then, I get my income potentially from two sources, from the operating companies that pay profit, which fund your ordinary dividends.
Yes, yep.
And you have a potential for capital growth, and when you realise that, you will pay a special dividend. Is that in your mandate?
So look, these returns are so uncertain. I'm even sitting looking right at this point at this New Energy Finance Fund 3, going, right, we still have wind farms in Spain and that you can't get something over a bridge, and it's really quite interesting, but very, very uncertain. So the history has been when NEF1 wasn't successful. New Energy Fund 2 was successful, and that's when a special dividend was paid. In the next 36 months, we'll be in a position to know where the NEF3 fund is, and is there a possibility that there would be, a special dividend potentially if one, there is actually a profit, a capital return to look at. And two, if we just, if we have, if there isn't anything else that the organisation chooses to invest in, then absolutely we consider that as dividend.
Brilliant. Thanks, Karen.
Thank you.
Thank you very
Sorry, way
much.
over.
Thank you, guys.